to the Personal Pension Radio Podcast, where you get unconventional insights into retirement and lifestyle design that actually work. You don't have to settle for the same tired Wall Street advice. Break away from the herd and learn how to achieve the retirement lifestyle of your dreams. And now, here's your host, the income engineer, Kraig Strom.
Okay, back on Personal Pension Radio. We are currently broadcasting from Mr. Foley's van parked at 50 South Grand Avenue in Los Angeles, California. Of course, that is the Federal Reserve headquarters in Los Angeles. If you listen carefully, you can hear the digital money that fuels the fractional reserve banking system being created out of thin air. You've got to listen carefully, though. So we are brought to you by personalpensionradio.com. If you haven't been to the website, check that out. This is episode 61. Can't believe it. It's gone that quickly that we're at 61 episodes now. If you missed episode 60, we did not have a huge party with balloons or anything like that. Just business as usual, doing my best to put out good content, information that'll be helpful for you and your journey in retirement or on your way to retirement. So, what is Personal Pension Radio all about? It's all about really optimizing retirement income. The conversation in the financial world is generally focused on saving money and accumulating money, which is a very important component of retirement income planning. However, it's only one half of the journey to retirement. The journey to retirement has two components. That accumulation phase is one for sure, and then there's the distribution phase. So if you do not have a distribution plan, you cannot, in my opinion, achieve maximum retirement income. And here's the thing. Maximum retirement income does not happen with a product. So a mutual fund or life insurance or annuities or real estate by themselves do not optimize retirement income. That's just an individual product pitch or product idea. You have to have an integrated approach, a strategy that puts those together. Thanks to the death of private pensions in the U.S., back 40, 50 years ago, the majority of Americans had private pensions to look forward to when they retire. Nowadays, the only folks who have private pensions are government employees, firemen, police, teachers. Now, that's awesome. However, with the loss of those pensions, Americans, folks like you and me, are now faced with retirement income crisis. We're now responsible for our own investments, our own retirement income plans, and unfortunately, most people aren't actually going out there and doing it, and they just don't know what to look for. So that's what Personal Pension Radio is all about. A quick disclosure before I jump into the show. I am not an attorney. I'm not a CPA. I am a certified financial planning professional. But please don't act on advice that you hear on this show or, for that matter, from financial entertainers or radio broadcasters or things you see in newspapers or other publications. Specifically because you need to have advice tailored to your situation. Meet with a qualified advisor, a licensed advisor. Financial entertainers on the radio generally are not licensed. They don't have time to get to know you or the people calling into their show, for example, and then they're doling out advice that could be life-changing, life-altering advice. Keep that in mind. Get your advice from a source that's actually sitting down with you, getting to know you. Okay, so there's the quick disclosure. Now, a shout out for listeners in Florida. Please, listeners in Florida, we've got a fantastic audience that the downloads are awesome. I love that, but I'm going to put out a little challenge for the folks in Florida. California, I am home based here in California, continues to be the number one state for downloads. Close behind is Florida. So here's the challenge. Here's the challenge for everybody in Florida. Share this with your friends in Florida. Let's see if we can bump Florida closer to and maybe even surpass California as the number one download state for Personal Pension Radio. So there's your challenge. Let's see if we can get ahead of California. Now, first section today. Let's go through and take a look at Watch Your Step. Now, Watch Your Step is a section, for those of you who are new, that I like to just go through the news and see what's out there and just give you an idea of what's on the radar that might be for you to pay attention to or be worried about or concerned about. Okay, so now there's going to be two here that I saw today that actually had the Department of Labor. Now, some of you might be wondering, this seems like a retirement show, which it is, retirement personal pension, right? Why am I talking about the Department of Labor? Because it doesn't sound right. To me personally, it does sound a little weird that the Department of Labor is heavily involved in what the world will look like for you and your retirement planning. So, the Department of Labor has come to our rescue as it relates to the retirement crisis in America. Here's what I read in the news today. And by the way, all of these links will be in the show notes. So you can actually just go to the show notes, and once we get those up there on the website, and just go and read the article yourself. But the Department of Labor is now going to begin a long-term study to figure out how retirement planning strategies and decisions evolve over time. Yes, the government to the rescue. Okay? They're going to help us figure out how retirement decisions are made. Now, here's my take on it. Thanks so much, but you're way too late. The retirement income crisis is already fully underway. Baby boomers are retiring at 10 to 15,000 a day. The retirement income crisis is already upon us. The train has left the station, and here's the Department of Labor coming in saying, we're going to do a study. Well, let me help you. Here's the answer. The world is full of distractions in relation to financial planning. Financial planning gets very little attention in our day-to-day lives because we're so busy being bombarded with everything else, whether it's from the news, whether it's from our children, whether it's from work, whatever it is, we're just crazy busy, and it's hard to pay attention to that retirement planning thing that's way off in the distance. So that's number one. Number two, the default, open quote, I'm doing air quotes now, rule of thumb advice that's out there in the media and in the financial world has been taken, right, by everybody, let's say everybody, by the majority of folks out there who ever do stop and think about retirement planning. That rule of thumb, or as I call it, the conventional wisdom, is being taken and followed rather than getting individual plans formatted for your specific situation, right? People are just following rule of thumb advice. They're watching a television commercial by a big financial firm that says the answer to retirement is to save more money. Oh, well, I better go open a savings account or a retirement account or an investment account and just save more money. And how much should I save? Well, the rule of thumb is this, so I better do that. There's no specific individualized planning being done. Majority of folks just aren't doing it. Okay, so that's the answer. The Department of Labor could have just called me, saved millions and millions of dollars. I'm sure they're going to spend on some long-term study to find out that folks just it's hard to pay attention to it. It's hard to sit down and actually make sure that retirement plans are on track, let alone making sure that we can actually get through retirement with income. And then the next one I wanted to cover is this article that I read. It was an article here in, I think it's a Benefits Plan magazine, and it was this idea that a comment stood out to me that I just wanted to comment on and give you something to think about. It was a comment that said, it's never too late to start retirement plans. I agree and I disagree. I want to be a bit just direct. I don't want to pull any punches. Let me just say I agree that if you're already at the doorstep of retirement, it's too late to make a significant difference in what your maximum income could be. However, it is possible to enhance the income that you might have already started or might already be considering by rearranging the assets that you have for retirement income. So this blanket statement that says it's never too late to start retirement plans, I disagree in general. Yes, it is too late. It's too late to make an improvement. So getting up to the doorstep of retirement and then saying, hey, let's do a retirement plan. Well, too late. You already made your retirement plans. Now, all you can really do is hope to make whatever you have as good as possible. The retirement plan is actually starting ahead of time, actually putting 5, 10, 15, 20 years on the calendar and actually having a concerted effort towards a goal. So the idea that it's never too late to start a retirement plan is just, again, a blanket statement from a financial publication that really should have been a heck of a lot more specific and said, well, it's never too late to try and enhance your retirement income. It is too late to start retirement planning, because if you get to the end and that's when you choose to start retirement planning, you've already done your retirement plan. Now you have to work on your income plan, and all you can do is deal with what you've got. So if you are at that point where you waited and waited right up until the doorstep of retirement, and when I say doorstep of retirement, I'm talking about within 5 to 10 years, that's the home stretch. That's the doorstep is in sight, top of the mountain, you're almost there. If you've waited that long, now the time has come to really focus on the income strategy. How are you going to arrange the savings and the assets that you have and that you will have along the next few years? How are you going to arrange them in the most efficient way to get maximum income in retirement? That's the question. If you have not yet started, but you have 15 or 20 years before you get to the top of the mountain, you have time to actually put a coordinated effort in place for the accumulation cycle and the distribution cycle. So keep that in mind. That's a big one. And then one more here for the Department of Labor. Again, the idea that the Department of Labor is involved in your retirement planning life is a reality. It's an absolute reality, and there's been something that the Department of Labor has been working on for a while. The Department of Labor has been working on something called a fiduciary standards rule. A fiduciary standards rule that proposes a fiduciary rule, which had been sent off to the Office of Management and Budget, that's a government agency, back in February of 2016. And this rule opposes, now follow this, opposes in-person retirement advice provided by commission-based financial brokers. Instead of, all right, so it opposes you meeting with a financial advisor who might be a commission-based advisor, and it supports the Obama-favored option of using, now check this out, robo-advisors or fee-based services for investments. Now, this, again, you got to hear this, that the Department of Labor fiduciary rule opposes in-person retirement advice, specifically provided by a commission-based financial broker. And instead, it actually supports using automated, think robots, robo-advisors, or fee-based services for investments. Now, I've talked about fee-based versus commissions versus percentages of asset management and so forth. And it all, for me, just to clarify, comes down to biases. That everybody has a bias of one form or another. So if you're working with a fee-based advisor that has a bias that could potentially be in favor of certain working programs that benefit them, well, it doesn't matter if they're a fee-based advisor or not, that bias could negatively impact the client, right? That bias could negatively impact the client. So if you look at a commission-based advisor, Well, if you have a commission-based advisor, the person has a bias that might be in favor of going after higher commissions. Well, that's a bias that negatively impacts the client as well, right? So the bias is the key here. Personally, I believe that fiduciary rule or not, you have to work with an advisor whose primary bias is in favor of you, the client. So this is what's happened in the news just recently, right now, that the fiduciary standards rule that is being proposed by the Department of Labor has been blocked by government, Congress, etc. They've blocked that rule for now. The Department of Labor, the Obama administration, they're still working on bringing that back to the table. And personally, I believe it can have a significantly negative impact on us as just financial advisors, but also a negative impact on you, the just general public. It could have a significantly negative impact, for example, on low-income households trying to get their financial advice and perhaps not having access to the financial advice that might benefit them, and having to go to a government website or a robo-advisor to get their advice. So this idea of a robo-advisor, if anybody's ever listened to my show, you know that I'm a big fan of making sure that everything is as efficient as possible. So efficiency is a big thing, and robo-advisors can be efficient, but what they're not is personal. They don't know your specific situation. And it's nothing of, I guess, no offense to Obamacare or government entity or whatever, but I don't think they know you either. So, and personally, I don't believe that the government should be involved in doling out financial advice of any kind. But that's the kind of stuff that's coming down the road. Right now, the DOL fiduciary standards rule has been blocked. It's going to come back again. I'll keep you posted for sure. So let me jump on to listener questions, listener and client questions. So a question came in from a listener that asked a really good question. What is a defined benefit plan? A defined benefit plan. Now, this question has come up before, and it's not one that you hear often. So just a quick explanation. There are two basic types of retirement plans: a defined contribution plan and a defined benefit plan. So a defined contribution plan is one like a 401k, where you have a specific amount that you can contribute, a defined amount, to a retirement plan like a 401k. Let's say you can put in $18,000 a year into a 401k. That is your defined contribution. Now, the amount that you pull out on the other end in the distribution phase depends on how much the account grew up and what the investments did and so forth. So that's a defined contribution plan. A defined benefit plan is different. It is exactly what it sounds like, where the benefit, the outcome, distribution side of the equation is the known number. So at the end of the time when you've put your money into a defined benefit plan, at the end, when you start your distributions, the income number is known. There is a formula, there's factors that say this is how much your income will be from this investment account. It's also referred to as a pension. So an example of a defined benefit would be, for example, a teacher's benefit that they get in their retirement from CalPERS here in California. That's CalPERS, CalPERS, the California Personal Employee Pension or Pension System. I forget what the acronym is. But that's a defined benefit plan where a teacher, for example, will give up in their contract or their employment agreement a certain amount of their income, which is allocated towards their defined benefit pension plan, so that at the end, when they get to the top of the mountain and they get into distribution phase, the benefit that they receive is known. The amount of money that might accumulate in the plan, the contributions, is not specifically known as far as how it will, grow and what the rates are, but doesn't matter because the benefit is actually listed and defined in the plan. So defined benefit plans are rare. However, you can still get a defined benefit plan. You can get them for private companies. It's generally a company plan. It's not necessarily an individual item. However, you can get things that are similar to a defined benefit plan using things like guaranteed annuities. That's a whole different topic, but guaranteed annuities can be used to create a pension-like income, much like a defined benefit plan can provide that says, here's the income, it's known, it's set, there's no questions about it at the end. So defined benefit plan versus defined contribution plan, you will see the predominant retirement plan in America is a defined contribution plan, namely the 401k. The 401k is the primary retirement plan. Very few defined benefit plans left out there. If you have questions about a defined benefit plan and how that might work in your business or whether your business offers it or not, go to personalpensionradio.com. Send me a note. We've got a lot of questions coming in and specifics people are asking about. Happy to go over the details with you, but that's the basics of a defined benefit plan. Now, another listener question, do retirement plans have tax advantages? Now, that sounds like a very counterintuitive or like, duh, of course they have tax advantages, but I believe this is actually a very, very good question. That's why I included it here in today's show. Do retirement plans have tax advantages? Well, let's talk about it just briefly. If you have an IRA, an individual retirement account, one of those types of accounts, does it have a tax advantage? Well, I believe it does because let's say we're going to put $5,000 into a retirement account. Well, we are able to take that $5,000 and postpone the taxes that we might have paid on that $5,000 of income because we put it into the IRA account. So we don't pay current taxes on that contribution. Now, this is a very, very important point. A lot of people say there's a tax deduction for that IRA, that retirement account. I believe that's a myth, that's a misstatement. There is a tax postponement. So the big tax advantage to an IRA or a tax deductible, air quotes, plan is what do you do with the taxes that you save this year? So let's think it through. If you put money into an IRA and you would have paid, let's say, $500 in tax on that income. So let's say you would have paid $500 in tax or $1,000, doesn't matter. The money is now in the IRA. It has not yet been taxed. So the real big advantage that I see is what you do with the tax savings that has not been paid today. So let's say it was $500 that you would have had to pay in income taxes to the government, but it's still basically in your possession. It's held inside your IRA. However, what if you took $500 in other savings, money that you have in your other savings plans, and you put that $500 aside to invest or to grow in some other account? Okay, so you allow it to grow, and in the future, what is the government going to want from your IRA? They're going to want the taxes that have yet to be paid, right? So if you have not saved up somewhere else, where are those taxes going to have to come from? They're going to have to come out of that IRA account, right? They're going to have to come out of the IRA account. So if you have saved elsewhere, you've built up additional savings that have grown up perhaps that can help to cover some of the taxes that will have to be paid on that IRA account. Okay, so that's just one way to look at it. So there are tax advantages to IRAs and 401ks and such, but you have to be clear and think it through. There's no such thing as a tax deduction for an IRA or a 401k. It is a postponement into the future. So you could also argue that if your retirement income plans are such that you're going to have a healthy, a very strong income in retirement, well, you might actually be in a higher tax bracket when you retire. And now the withdrawals that you take out of your IRA could actually be taxed at a higher rate than when you were actually putting the money in. That's the thing to watch out for. So now that could become a significant tax disadvantage. So something else to consider there, right? If you put your money in today, and let's say you have husband, wife, 2 kids, a mortgage, right? Maybe some business expenses that you're able to offset income with. The kids, are legitimate tax deductions. The government doesn't come back after those tax deductions once they grow up and, get out of the house. But they do come back after that tax deduction that they gave you on the IRA or 401k. So if you end up in a higher tax bracket because you don't have kids to deduct, you don't have a mortgage to deduct, you may not have business expenses anymore to deduct, and now all of your income is taxable, you might actually be in a higher tax bracket, and now you're in a disadvantaged situation when it comes to retirement planning. So I know this sounds like I just said, yes, there are tax advantages, and no, there aren't. I guess that's what it needs to be said. It depends on your specific situation and what your retirement income planning looks like, what your retirement income planning looks like. To be clear, if your goal is to have maximum retirement income, I always encourage folks to plan for the same or higher tax bracket. So if that's the case, that might help you plan out your tax advantaged or tax deductible retirement plans today. So keep that in mind. Now, a client question, should I roll over my old IRA, individual retirement account, into an annuity now? So these folks actually want to be positioned for retirement income, and a guaranteed annuity is one of the ways that you can actually hold retirement assets and then turn them into a stream of income that could last for as long as you live, for example, right? Depending on the insurance company, and the disclosure would be depending on the health and financial ratings of the insurance company that you use. All that aside, the question was, should I roll over my old IRA into an annuity now? Well, this particular client has about 15 years to the retirement timeline to get to the top of their mountain before they get into the income distribution phase. So I would think at this point, rolling into a low return guaranteed annuity position could be premature. So my initial reaction is probably a premature place to be. So there's a lot of sales pitches out there as it relates to different types of annuities. Oh, they've got bonuses and they'll give you all kinds of interest, and they'll throw money at you to come in and get your annuity. Well, let me give you a quick heads up on this. Annuity companies, or annuities, are offered by life insurance companies. And generally, what I tell my clients is that life insurance companies, they all swim in the same swimming pool as it relates to their investment portfolios. There's no magic between one insurance company or another having some superior ability to come up with a greater rate of return on their investment portfolio. So they all generally have long-term, consistent, most cases secure investment returns on their life insurance company assets. So if they all swim in the same swimming pool, how is one annuity company going to be able to give out these amazing, I saw a bonus of something like 22%. I got a thing in the mail that there was an annuity that offered a 22% bonus. How in the world does that company offer a 22% bonus? How could that be real? Well, the truth is, I don't believe it is. It's not real. That insurance company has to take away some benefits somewhere else in that arrangement, because there's no possible way that that insurance company can offer such an upfront bonus. So don't fall for those too good to be true upfront annuity sales pitches, because the annuity world, they all swim in the same pool in that arena. So the question was, should I roll over my old IRA into an annuity? For this particular client, having about 10 to 15 years until retirement, my initial reaction is no. Now, when we dig into this in further detail, maybe there's a rationale behind it, but I believe their timeline is long enough that there are other things that need to have attention paid to them before they look into that kind of a financial decision. There's a lot of other things that they need to do prior to being worried about or considering that income side decision for a product. So hopefully that answers a question there. Now, final question from a client. This seemed to be a busy question week, so I had 4 really good ones here. So, term insurance versus cash value insurance. This came up as a question from a client that should I buy term insurance or should I get cash value? Now, this is a really broad kind of sweeping question. And what I want to do right up front is I want to make sure to lay out something that I think a lot of folks who know me, clients know me, listeners to the show might have gathered is I'm a huge fan personally of properly designed cash value life insurance. Not variable life insurance, not indexed life insurance, just good old-fashioned, properly designed, dividend-paying, mutual whole life insurance. I'm a big fan. However, with that said, the answer for this particular client is absolutely not. That someone actually suggested to them at their state in life, okay, they're in their 30s, they're in their mid-30s, they have 3 kids at home. Okay, so 3 kids at home, and both of them are working. And someone actually suggested that they should put their finite dollars. They don't have tons and tons of money to put into anything, including savings, but to put their finite dollars into cash value insurance, right? And it wasn't even the type that I just mentioned. It was a different type of life insurance. It was it was indexed universal life, because look, you get these benefits and the death benefit and savings. I was just floored with this particular question. So my answer is a resounding no. Let's step back for a second, make sure that you understand my position here. I just told you I really do love personally cash value life insurance. It's a big part of my own retirement income planning, my own personal savings strategies. However, life insurance, first and foremost, is about protection. It's about protecting this family. And cash value insurance will not provide, based on the amount of money that this family can actually set aside, it will not provide the death benefit protection they truly need to be safe. You've got a family, you've got husband and wife who rely on each other. The most important thing is to find the death benefit amount that fits their financial situation. Cash value insurance, personally, is something that comes after you've protected the family, after you've built a good, secure cash on hand position with your emergency funds. After that, I start conversations with clients that might include things like cash value insurance. So in this case, the answer is absolutely not. Anybody who's trying to pitch you on cash value insurance before you have gotten your good basic term insurance done right, I think is just, it's making the financial community look bad. That's just the wrong thing to do. So that's, again, that's my position. And then as it relates to term life insurance, There's only one company that I know of that offers this particular benefit, so I want to mention it again. This company happens to be under the One America family with American United Life. I can put all that in the show notes, but more specifically, let me cover this benefit. Term insurance by itself from most companies is just a death policy that says if you die, term insurance pays out. And of course, that's what we want from good, inexpensive term insurance. Now, the term insurance that I personally have, offers me a benefit that no other term insurance offers. It offers me the ability to convert my term insurance into a cash value life insurance plan that pays a benefit for long-term care. So let me explain. So under standard term insurance, the only way to get money out of standard term insurance is you have to die or be diagnosed soon to be dead. That's the reality. Under my term insurance that my wife, my daughter, myself, that we all have, my term insurance says, yes, if I die, my wife gets a nice big benefit. And if I am diagnosed soon to be dead, my wife and I can draw from that death benefit while I'm alive, going through hospice and things, tough times like that. But if I have a car accident where I'm permanently injured or become a long-term care patient, where I have a stroke or I get Lou Gehrig's disease, something terrible like that happens to me where I'm not diagnosed soon to be dead. I could live for years with a long-term care situation. I can convert my term insurance into a life insurance policy, a cash value life insurance policy specifically designed for long-term care benefits and start receiving reimbursement for long-term care tax-free. Okay? Now, this is a great call to action for everybody listening. Check your term insurance. 99% of the time, maybe more, your term insurance does not offer that benefit. It does not offer that benefit. And my personal opinion, that is probably the most valuable insurance benefit that I have that doesn't really cost me anything extra. I changed all of my term insurance. As soon as I found that option, I changed all of my term insurance to this particular company so I could pick up that one benefit. That's huge. That's a fantastic benefit. So now I want to jump into something just real quick because this is tax time. One more, I think another episode or two on taxes, and I might make this a regular part of the show. I'm going to call this a State of the Union. This is the State of the Union. You can actually go and look at this information yourself at the usdebtclock.org. usdebtclock.org. If you've never seen it, it is a huge wake-up call. You really got to take a look at this. So you go to, and I have the link in the show notes, so you can actually go check it out. So now, U.S. debt clock. The national debt for the United States currently, well, it's higher now because it goes up every second. The national debt is $17.46 trillion. The student loan debt in the U.S. currently is $1.3 trillion. That personally right there, that is such a tremendous, tremendous amount of money. The student loan debt in America is absolutely ridiculous. Government free education has caused education institutions to jack up their prices so high because they're getting free money rolling in from the government, basically just sending an entire generation of students into the world with the largest amount of student loan debt ever in the history of the planet, $1.3 trillion. Now, here's the fun ones, okay? Because whenever I have a conversation with people about the idea of taxes being higher in the future, I have some people who say, oh, no, I'll be in a lower tax bracket. You hear that all the time. But whenever I ask folks in a group setting or in a presentation or in a class, do you believe that taxes will be higher or lower in the future? Everybody says they'll be higher. But then when you get down to it personally, a lot of folks think, oh, no, I'll be in a lower tax bracket. Well, let's go through these last ones here. Social Security liability. Okay, so the Social Security liability, what that means is how much money is the government on the hook for in the future with Social Security benefits. Now remember, the national debt was $17.4 trillion. The Social Security liability, the upside down status of Social Security is $14.7 trillion. $14.7 trillion. The Medicare liability, okay, so Medicare liability, this is for the health insurance side of the world, is $27.6 trillion. $27.6 trillion. The total, here we go, the total unfunded, meaning they don't actually have the money, the total unfunded liability in the U.S. today, $101.3 trillion. Total unfunded. So if you think for a second, this is my opinion now, I'm jumping up on my soapbox. If you think for a second that government taxes and fees aren't going to be higher in the future, oh, you're fooling yourself. You're crazy. Government taxes and fees can only go up because the government is on the slipperiest slope they've ever been on. Unfunded liability of $101 trillion. Now, if you don't know what $1 trillion looks like, go to Personal Pension Radio in the show notes, and I've got a great page that outlines exactly what $1 trillion looks like. Okay, so $1 trillion is an amazing, amazing amount of money. All right, so I want to finish with a couple of hard client stories that I don't know how else to say it. I need to motivate as many people to stand up and take action, because you heard me at the top of the show talk about the Department of Labor and their new long-term study about why, how people make decisions for retirement. Well, I suggested they don't. They just procrastinate, right? Well, I don't know how else to motivate people sometimes, but I got to give you a couple of hard-hitting stories that these are experiences that have happened to me right here in my office, and I'll never forget them. So this is a doctor who came to visit with me. He was introduced by a personal friend of his who was a client, said, you got to go meet with Kraig and sit down. He's a great guy. All right. So here he comes and he sits down and we go through his personal situation over the course of an hour. And I've asked lots and lots of questions, and it is clear to me that he needs more protection for his family. Right? He kept asking questions about investments and investments and investments, and I kept bringing him back to protection, 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 because investments don't protect anyone. They just don't. They sound good. It sounds good to have a big 401k or a big investment account balance, but if your family's not protected properly, right? That's the issue. So this doctor just said no. He didn't. He wants to handle his own investments, and his protection is just fine. And he doesn't need any more life insurance. That's one of the areas that we talked about, that he had cash value life insurance that had been pitched by a financial advisor suggesting that he can use it as a retirement savings vehicle. Well, yes, I guess you can, but most important thing about life insurance was protection, right? And if you get the insurance from the right company, like I mentioned earlier, you might pick up some additional protections that most companies don't. He said, nope, I've got it all set, and he left my office. And 2 years later, he was diagnosed with a medical condition that took doctors months and months to figure out. Now, keep in mind, this guy is a doctor. This guy is a doctor, works with his hands. It took the doctors that he worked with months to figure out what was wrong with him. And by that time, it was really too late, of course. It was totally too late. And over the course of the next 2 years, he slowly fell into complete inability to function and ultimately passed away and died. and left his wife in a total financial mess because the protection wasn't right. All of the savings and investment discussion didn't help that much. Really wasn't a big impact. The protection would have been a huge impact. So can it be too late? Yes. Today is the best possible day for you to get in touch with me and have your protection component reviewed. Don't wait. If you've never had your life insurance, your car insurance, your home insurance reviewed by someone like myself who specializes in the entire conversation of financial advisory, protection, savings, growth, get in touch. Don't wait, okay? Because it can be too late. You have no guarantee that tomorrow is the last opportunity that you should have taken, right? You have no guarantee. And finally, this is a question as it relates to just planning for the next financial downturn. If you're a business owner out there and you've thought about selling your business, here's a story that I want you to really think about. This is a story of a husband and wife, and they've been running their successful business for years, many years together. They are a great team. Prior to the recession, 2006 and 2007, the thought of selling their business really started coming up because she, the missus, was having some pretty ugly health issues. Now, financially, they were fine, well protected, well balanced with all of their cash and savings and income, but they really thought about selling primarily because, her health was waning and she was struggling. So they thought now is a great time to sell. The tough part is that they went into the opportunity to sell their business at a very difficult time. Her health was in bad shape. She was in bad shape health-wise. And then they got a really great offer, but they weren't able to really pay attention. They did not have full attention on the deal because they were trying to manage the sale of their business by themselves. They were doing a lot of their own negotiations. They were involved. They weren't able to really focus on it. And what ultimately happened is they actually finally worked their way through to get to a deal. They got a great offer on the table, and then they couldn't get themselves focused enough to say yes. And they hemmed and hawed about details that should have been handled by professionals like myself and a business sale team and attorneys and CPAs really should have been handled by other people, right? And they just tried to do it themselves. And what ultimately happened, their procrastination and their inability to get it all done because of what was happening with her health led them right into the train wreck of the 2008, 9, 10 recession. And that offer to buy their company for the best price that they might have ever seen in 30 years immediately disappeared. And they went back to basically working full-time. The value of their business dropped substantially. The economy just kicked their business right in the kneecaps. And then they've now built back out of the hole. The values come up. And here I am all along the way trying to get them into the conversation of let's get ready for sale. And once again, procrastination has been exacerbated by her health issues that have come back. Okay? So as you look down the road and you think, I'd love to sell my business or I'd love to retire, now is the time to engage with a team approach. Engage with a financial planning team. Make sure that you've got the right people on your side of the team to help you through this process so that you don't miss an opportunity. And if you're in that situation where you missed the opportunity or you had to delay the opportunity before the recession, now's a great time to get in touch with someone like myself and start that conversation up again. Don't miss it. It's a great time to be talking about it right now. So that's going to finish us up here for today for this episode. As always, thank you again. Don't forget, everybody in Florida, You got to share Personal Pension Radio with your friends in Florida. I want to see if you can actually catch up with California as the most downloads of any state in the U.S., okay? I know California's got a great big giant population, but I think Florida's got better weather. So you guys need to catch up. Now, keep those questions coming to personalpensionradio.com. You can contact me there. You can find all the information there. Really appreciate all of the support. We'll talk to you again real soon.
Listening to the Personal Pension Radio podcast. We took notes for you, so if you missed any part of the show, you can find a full transcript on each episode at personalpensionradio.com. Be sure to download your free retirement income crisis report at personalpensionradio.com. While you're at it, we would appreciate some iTunes love. Please leave us a fantastic rating on iTunes by going to personalpensionradio.com/iTunes. Thanks again for listening. Before we begin, we need to take care of a little housekeeping. Information presented is for educational purposes only and is not intended for solicitation, sale, or purchase of any security or financial product. Be sure to first consult with a qualified financial advisor and your tax professional before implementing any strategy discussed here. The term personal pension refers to a marketing name designed to educate future retirees and retirees about the economic principles behind creating their own pension-like income. The term personal pension is not intended to be confused with a defined benefit pension plan offered by an employer or by a government entity.